You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, my co-host Sam Ball. This week on The Investor Way, we have BAE Systems, IHG, Centrica, Coca-Cola Europacific, BHP, Wolters Kluwer as our European company of the week. Sam, shall I kick us off with BAE Systems?
Absolutely. How are they doing?
Very well, as one might expect with the current backdrop. But they had their full year results out. It's now actually a couple of weeks ago, or a week behind. Full year sales rose 10% to £30.7 billion, and that was at the top end of the company's guidance. All divisions contributed positively, with platforms and services growing at the fastest pace, up 17%. Underlying operating profits grew 12% to £3.3 billion, and that was slightly ahead of market forecasts. And the order book grew by £5.8 billion to a record £83.6 billion. Free cash flow fell from 2.5 to 2.2 billion against the 1.4 billion expected, and net debt, including lease liabilities, improved from 6.9 billion to 5.6 billion pounds. In 2026, sales and underlying operating profits are expected to grow between 7 and 9% and 9 and 11% respectively. A final dividend of 22.8 pence per share was announced, taking the full year total to 36.3 pence, which was up 10%. And the shares were up nearly 2.5% in early trading. In terms of valuation, the group have a market cap of £64.5 billion and trade at 24 times forward earnings compared with a 10-year average of 14.3, and they have a prospective dividend yield of 2%. I thought these results were really good. We've seen this now fairly consistently over the last few years, really since the Russia and Ukraine war kicked off, and I suppose the world becoming a more uncertain place, countries taking their security more seriously. Obviously, within NATO, there's the pressure to increase spending, and BAE Systems, as a trusted partner, which is a UK-based firm, is primed to benefit from that. I think it's a company that has a big moat, like a lot of these big defence contractors, and it's something that is very, very difficult to penetrate with all the security concerns. So, yeah, it looks at the moment very toppy in terms of the valuation, but I think with the events that we've seen this week, and just for reference, recording on Sunday the 8th of March 2026, you can see where they're getting that, because they'd expect that order book to grow further, and we're talking about high single digits, but who knows what it's going to be in the next year or two. Would I buy shares? I'd probably be a little bit hesitant at the current valuation. And I think also become a little bit anchored. It's a company that I think we've both followed for a number of years. It is very capital intensive, but when times are like this and with the uncertainty, it is certainly doing very well. Sam, what are your thoughts on BAE Systems?
In terms of the results, I don't think you can criticise them. I think for a company of their size, like you say, it's very capital intensive anyway. So actually ramping up production of anything is quite difficult. It helps when you've got the order book. I think the company's done really well in the last few years, but I think at a forward P of 24, I just wouldn't be comfortable buying it for 10% growth a year. I appreciate there's a lot of geopolitical uncertainty and that might continue, and you might be here in a few years' time and it might have actually looked cheap if you could have bought it at 24 times earnings 3-4 years ago. But it has historically been a cyclical stock. I don't know where we are in the current cycle, because obviously it's not as predictable as maybe certain other cycles might be. However, I wouldn't say it's anchoring, but I think, if you compare it to when we first started covering it 5 years ago, it's up 357% since then. So it's done very, very well. But if you compare it, although it's benefited from a much more favourable geopolitical environment, the performance has been fantastic. It had a lot of legacy kind of pension issues when we first started covering it. Those aren't really talked about that much now. I think they've solved a lot of those kind of legacy issues, and it's allowed management to actually just focus on the core business. And that has coincided with a much more uncertain political environment. So they've been able to capitalise on it. But yeah, really good performance, but I just wouldn't be comfortable paying 24 times earnings.
Do you think it's also benefited, quite apart from sort of geopolitical uncertainty, that there's been that shift from some of those capital light businesses that AI is, or the market's considering AI disrupting? And with this kind of business, potentially it's with all of that sort of capital intense production of planes, etc., is less vulnerable to that.
Possibly. I mean, the last month it's up nearly 18%, but then the last month has included kind of the AI drop, but then also the invasion of Iran. So it's hard to separate one from the other. I suppose if you go back a bit further over 3 months, it's up 32%. So it probably has rallied. I mean, it had already had kind of a fantastic couple of years, but yeah, it does seem to have rallied a bit more as one of those defensive stocks when all the AI concerns have been coming through. And it is hard to see this being disrupted by AI anytime soon.
And the other thing to say is it does have the digital side of the business for cybersecurity too. So that's interesting, I think.
Should we move on to IHG then, a much more capital light business?
Yeah, how are they doing?
They're doing pretty well. So IHG, it's a company we have covered before, but I don't think for a while. So it's InterContinental Hotels Group, for those that aren't familiar. So their brands include InterContinental Hotels and Resorts, Kimpton, Six Senses, Regent, Vignette Collection, Hotel Indigo, Crown Plaza, Even Hotels, Holiday Inn, Garner, Atwell, Staybridge, Candlewood. So they've got basically a load of hotel brands and they mainly license them out. So very capital light. 73% of their rooms are franchised. 27% are managed by IHG Group, but then kind of the building and stuff, they're not responsible for that. It's just the management. And less than 1% are actually owned or leased by IHG. So really what they make money from is from licensing out those brands to franchisees who want to open hotels with the IHG brands. So they have come out with their full year results and total revenue was up 5% to 5.2 billion, and all these figures are reported in dollars. Operating profit was up 15% to 1.2 billion. Earnings per share was up 26%. Dividend per share was up 10%, and the net debt was up 20%. Global revenue per room was up 1.5%, with the Americas up 3%. Europe, Middle East, and Africa was up 4.6%, and Greater China was down 1.6%. Average daily rate was up 0.8%, and the occupancy was up 0.5%. Total gross revenue was up 5% to 35.2 billion. They opened 65,100 rooms in the year, which was up 10% across a record 443 hotels. And their global estate is now made up of 1,026,000 rooms, and that's in 6,963 hotels. They signed for 102,000 rooms in 694 hotels, which is up 9% year over year, excluding the Ruby acquisition in 2025 and the Novum signings in 2024. The global pipeline now stands at 340,000 rooms in 2,292 hotels, which was up 4% year over year and represents 33% of current system size. Fee margin is 64.8%, and that was up 3.6 percentage points, driven by positive operating leverage and step-ups in ancillary fee streams. And operating profit from reportable segments was up 13% to 1.265 billion. Net debt, as mentioned, increased by 551 million, and that was driven by over 1.1 billion of shareholder returns through dividend payments and share buybacks, $120 million acquisition spend, 69 million foreign exchange adverse impact on net debt. There was a $900 million share buyback, $270 million of ordinary dividends paid to shareholders in 2025. And for context, that is on a market cap of $19.63 billion, so that's about 5%. And they've got a new premium brand, the Noted Collection, which was launched the day the results were announced. And they also acquired the urban lifestyle brand Ruby. In terms of the valuation, the business trades at a PE ratio of 27 and has a dividend yield of 1.41%. I think this is a really high quality business. I think they've got some very strong brands. I think the business model is very attractive. But unfortunately, I think it is just reflected in the price too much. I think if I'm paying 27 times earnings, I would probably want growth a bit higher than 5% a year. I know the operating profit's up more at 15%, but I just think if I'm paying 27 times earnings, as high quality as the business is, I would just need to see more growth from it. But in terms of the business model, it's a very, very attractive business model. I suppose my only other kind of gripe with it would be maybe the margins. If you look at some of the other capital light businesses that are available, like your Rightmoves, for example, the operating margins are a lot higher. So IHG's operating profit is just under 1.2 billion on 5.2 billion of revenue. So as a percentage, it's 23% operating margin. You compare that to Rightmove, it's more like 70%. Baltic, Auto Trader, all much higher. That being said, obviously that will be the managed hotels that's dragging that down, because that will just be lower margin than the franchised. But still, excellent business, very attractive business model. But yeah, I just wouldn't pay 27 times earnings for it. What about you, John?
Yeah, no, I agree. I like the company, I like the model, but it is just very expensive. And I think particularly at the moment, in terms of the capital light businesses that have suffered from this rotation with the fears of AI, you can get some excellent businesses for much, much less, and Rightmove being one of the top companies in that list.
Should we move on to a company that's not been disrupted by AI?
Yeah. So again, it's interesting. The more that we've covered in the last couple of weeks to see which businesses have been hit and which haven't. But Centrica, which is the owner of British Gas, certainly hasn't. Although it is a very much a price taker when it comes to commodities. So their full year revenue fell by 9% to £22.4 billion against the £22.3 billion expected. And that was driven by the lower oil and gas prices. Underlying cash profits, EBITDA fell 39% to £1.4 billion against £1.3 billion expected. And the decline was driven by its optimization business, which fell well short of expectations due to unfavourable energy prices and the pausing of energy storage. Underlying free cash flow fell from an inflow of £1 billion to an outflow of around 200 million, largely due to higher capital expenditure. The net cash position fell from 2.9 to £1.5 billion. In 2026, retail cash profits are expected to land in the between 500 and 800 million pound range, whilst optimization cash profits are expected to be around 250 million pounds. The full year dividend increased 22% to 5.5 pence a share. Share buybacks had been paused. The shares were down nearly 8.5% in early trading. In terms of valuation, the group has a market cap of £8.7 billion and trades at 2.1 times forward price to book, compared with the 10-year average of 2.44, and it has a prospective dividend yield of 3.3%, compared with a 10-year average of 5.4%. I mean, these results disappointing, but it's a price taker. It can't make the price with commodities, and that's what it's the large exposure it has. I think it'll be very interesting to see what happens over the next quarter, particularly if energy prices continue to rise. You'd expect that to be a really strong tailwind from Centrica. For me, Centrica is a business I used to have. I held it largely before all the political interference and energy price cap in the UK market came in. I sold it the more interference there was. Initially, that was Theresa May with the energy price cap. And then we had further taxes, and you just felt that whatever these businesses do, people have no sympathy. So I felt that for that case, it wasn't investable anymore and sold out. I think you look at the valuation and they do look cheap. And if you're a value investor, and perhaps if you saw a different government that might be more sympathetic to it, for example, if there were a hypothetical reform government, maybe you see some sort of upside to it there. And certainly they've recovered an awful lot since the depths of COVID. Let's just see what the shares went down to at that point. Seem to think it was like 30 pence, something like that. And they're currently trading at nearly £2 now. So that does give you an idea when we thought that peak oil had gone and was never coming back. And now we're seeing energy security issues and issues with the reliability of green energy. You are seeing the big player in the UK sort of coming back. For me, though, I think there is still too much uncertainty, and for that reason, I would not be investing. Sam, what are your thoughts on these results from Centrica and Centrica going forward?
I think the results are disappointing, but like you say, they're a price taker, so they are limited in what they can do when it's driven by lower commodity prices. I think in terms of the price, though, in terms of the PE, it's the 17. The yield's currently under 3%. I appreciate the perspective is slightly over 3%. For a utility company, I don't even think it's that cheap at present. As you've alluded to, if it is a company that interests you, you have had ample opportunities in the past few years to buy it a lot cheaper. But yeah, I think sort of politically, just uninvestable, unfortunately. I think the only kind of similar business that I would consider would be Shell. I'd still probably consider that uninvestable, but I think that's probably the best of the bunch. And it's got much more of the LNG. I just think it seems quite pricey for what has historically been quite a poor performer.
Okay, on to Coca-Cola Europacific.
Yes, so I can't remember if we've covered this before. I mean, we've covered so many different variations of Coca-Cola that it becomes hard to keep track after a while. But Coca-Cola Europacific, they are listed on the FTSE. I'll just check when they moved, actually, because I think they're a recent addition. Yeah, so they moved onto the FTSE in March 2025. So it's probably one of the rare recent wins for the FTSE. And the primary reason was to increase the visibility and accessibility to a broader range of investors. So I'm presuming they must have had a primary listing on the Australian index prior to that. So Coca-Cola Europacific, they are basically very, very similar to Coca-Cola HBC, which we have covered frequently. They do the bottling and distribution for Coca-Cola, and they have the license, sort of franchise license, in a number of countries, which I'll go through now. But they are essentially Western Europe and Asia Pacific. They've got Andorra, Australia, Belgium, Cook Islands, East Timor, Fiji, France, Germany, Great Britain, Iceland, Indonesia, Kiribati, Luxembourg, Monaco, Nauru, Netherlands, New Zealand, Norway, Papua New Guinea, Philippines, Portugal, Samoa, Solomon Islands, Spain, Sweden, Tokelau, Tonga, Tuvalu, Vanuatu, and Wallis and Futuna. And they're actually the world's largest Coca-Cola bottler by revenue. They have come out with their full year results, and volume was up 2.4% to just under 4 billion units. Revenue was up 2.3% to just under 21 billion, and all these figures are reported in euros. Cost of sales was up 2.4%, and the operating profit was up 31%, just under 2.8 billion. Diluted earnings per share was up 38.3%, and revenue per unit case was up 1.6%. If we split the results between the two segments, which are Europe, and then the second segment is Australia, Pacific, and Southeast Asia, Europe was down 0.5% on volumes, but up 2.9% on revenue. So they've raised the prices and then lost the volume slightly. And the operating profit was up 23.7%. In Australia, Pacific, and Southeast Asia, volume was up 8.6% and revenue was up 0.5%, and the operating profit was up 66.4%. So the overall year-to-date value share has increased by 20 basis points, with Europe down 10 basis points and Asia Pacific up 90 basis points. They've said greater consumer focus on value contributed to softer volumes, particularly in Germany, with demand in France impacted by increased sugar tax. And in Southeast Asia, flat growth in the Philippines was offset by double-digit decline in Indonesia, reflecting a weaker consumer backdrop. The dividend per share is up 3.6%, and they've maintained an annualized payout ratio of approximately 50%. And the comparable return on invested capital was 11.5%. That's up 70 basis points, driven by the increase in comparable profit after tax and continued focus on capital allocation. And for the 2026 guidance, they've projected revenue growth of 3 to 4%. Cost of sales, they're expecting comparable growth of about 1.5%. And they're expecting operating profit growth of about 7%. CapEx, they're expecting that to be about 5% of revenue, including leases. And they've announced further share buybacks of 1 billion euros. And that's in a market cap of just under £33.5 billion. In terms of the valuation, they're valued at a P of 29 and they have a yield of 2.36%. I think it looks like a great business. I think it looks like a high quality business. I think a lot of what we've kind of learned in the last few years about Coca-Cola HBC, you can very easily apply that understanding to Coca-Cola Europacific. However, I think these figures are okay, but I think that valuation P of 29 is really expensive for a company that's growing a few percent a year. I appreciate operating profits are growing a bit more, but if you're only growing a few percent a year, it is a capital intensive business. I appreciate they might be able to get more and more out of the existing bottling facilities. I think it's quite expensive. I think the growth's not amazing. And I think when you look at the markets they operate in, they're all pretty saturated markets. I think Coca-Cola HBC markets are just much more exciting. And on top of that, Coca-Cola HBC is actually the cheaper of the two, despite, I think, having the better growth prospects. So yeah, for me, I think it looks like a good business, nothing particularly wrong with it, but I'm just not sure why I would ever kind of want to buy it when I can go out and buy Coca-Cola HBC instead. What do you think, John?
Yeah, exactly. It's just the business which doesn't have the geographies that I would like. And I think also you've seen how shrewd Coca-Cola HBC have been. So that would be my pick. But it's not a bad business at all. And I think, as you rightly say, the growth that they're putting up, it is really, really expensive.
So now that we've done a company that's moved its listing from Australia to the UK, should we move to one that's moved its primary listing the other way?
That's right. No, absolutely. So it's BHP Billiton, which is the world's largest miner. They have their half-year results out. And as you say, used to be UK listed, primary listing in the UK. I think it was about 5 years ago, something like that, when it moved. Anyway, first half revenue grew 11% to $27.9 billion against $25.9 billion expected, with underlying cash profit EBITDA rising 25% to $15.5 billion. Performance was driven higher by copper prices and iron ore prices, offsetting a small drop in volumes. Free cash flow rose by 10% to $2.9 billion, supported by improved earnings despite $5.3 billion of capex and exploration spend. Net debt rose to $14.7 billion, which is within the revised $10 to $20 billion target range. The group declared an interim dividend of 73 cents a share, which was ahead of last year and above expectations. And the shares were up around 2.5% in early trading. In terms of valuation, BHP has a market cap of £137 billion and trades at 3.25 forward price to book, compared with a 10-year average of 2.36, and it has a prospective dividend yield of 3.7%. I mean, I thought these results were very good. I don't think you can argue with them at all. There's a lot of tailwinds and there's been a lot of economic growth, and also the AI infrastructure and BHP being part of the build out in that, in terms of the commodities, particularly in terms of copper. They are the best in class. They have huge demands from China and India, and they seem to be able to produce it partly because they are the biggest player, and with some of their ginormous mines, the cheapest. It is an industry that's very volatile. And I remember when I used to hold shares, you could have what at the time, sort of 10 years ago, so were pretty big swings. I've moved away from some of these businesses. I think there is a lot to be said for it. I think it's also benefited from that rotation away from some of the capital light businesses with that perceived threat from AI. And this is very much picks and shovels on that too. And obviously very, very capital intensive. So, yeah, it's difficult to argue with these results, but it's whether you'd really want this type of business in your portfolio. And certainly, when the times are good, as they are, or as they have been recently, these businesses churn out huge amounts of cash. Obviously, when the times are bad, they are often very bad. Sam, would you ever invest in BHP Billiton?
Definitely not at this stage of the cycle, I don't think. So I know price earnings isn't always the best way to value these businesses, but 18.5 just seems really expensive. And then when you look at kind of how it's performed, it's up 5x in the last 10 years. It's almost doubled in the last 5 years. And this is a business that we know is pretty cyclical. So for me, I just wouldn't be comfortable buying it at the current valuations. I don't think the yield's particularly amazing. So for me, if I were to ever buy it, which is pretty unlikely because I don't really know much about commodities, I would probably be buying it when it's at a very different stage of the cycle, I think.
Fine. Yeah, on to our last company.
Yes, so Wolters Kluwer. So I'm not going to go into them in too much detail in terms of what the company does because we covered them for the first time about a month ago and we did kind of go through the different parts of the business. When we covered them about a month ago, we were looking at old results. It was a 9-month trading update, and I just thought it'd be quite interesting now that the full year results have come out to see how they've been doing in kind of the month since we last covered them. It might be 2 months actually, but it's certainly within the last couple of months. So Wolters Kluwer, they are a professional software provider. They have come out with their full year results, and revenue was up 4% to 6.125 billion euros, and all these figures are in euros. Operating profit was up 20% to 1.7 billion. Again, that's a pretty good margin. So the statutory operating profit margin is 28.3%, and profit for the period was up 21%. Diluted earnings per share was up 25%. Net cash from operating activities was up 1%. And in terms of the adjusted results, the adjusted operating profit was up 5% rather than 20%, and the adjusted operating profit margin stands at 27.5%, so pretty similar to the statutory operating profit margin. Net debt was up 28% to just over 4 billion, and the return on invested capital was slightly down from 18.1 to 18%. The recurring revenues, which make up 83% of the total, were up 7% organically, and non-recurring was down 1%. And the net debt to EBITDA ratio now stands at 2x. And for the full year outlook for the 2026 year, they've said we expect another year of good organic growth, a further margin increase, and high single-digit growth in diluted adjusted earnings per share in constant currencies. We expect the full year adjusted operating profit margin to increase while we simultaneously increase annual product development spending to 12 to 13% of revenues in 2026 to further advance our AI strategy. Our outlook assumes print will decline at a similar rate to prior year. And in terms of the figures for the outlook, they're expecting the adjusted operating profit margin to be up about 0.5% to 28%. Adjusted free cash flow, they're expecting that to be between 1.3 and 1.35 billion. For context, for 2025, it was 1.348 billion. So it's probably going to be, if you take the average down slightly. Return on invested capital, 18 to 19%. So that's up slightly if you take the midpoint of 18.5 compared to 18% this year. Diluted adjusted earnings per share growth, they're expecting high single digit growth, and it was 9% in 2025. And in terms of the outlook by division, for health, they expect the organic growth to be in line with prior years, so that's about 5%. Tax and accounting, they expect that to be in line, so about 7%, with revenue momentum picking up in the second half. Financial and corporate compliance, they expect that to be ahead of the 3% in 2025, with momentum picking up in the second half. Legal regulatory, they expect that to be ahead of the prior year of 5%, and the first quarter 2026 faces a challenging comparable. Corporate performance and ESG, they expect that to be ahead of the prior year of 7%, and the first quarter faces a challenging comparable. In health, they said they launched up-to-date Expert AI, adding an expert-validated conversational AI interface to their trusted clinical evidence to provide fast and transparent answers to complex medical queries and inform diagnostic decisions. And if we look at the divisional review, because one of the concerns that we did have last time was that health division and the impact of AI. So if we look at the revenue of each division, total revenue is 6.125 billion for context. Health is just under 1.6 billion of that. So health constitutes 26%. Tax and accounting is 1.66, so that's slightly higher. Financial and corporate compliance is lower at 1.23. Legal and regulatory is just a billion or just over a billion. And corporate performance and ESG is the smallest. That's only 625 million, so that's about 10%. However, in terms of the adjusted operating profit, that's 1.687 billion. Tax and accounting is the highest at 584. But then the second highest is health at 512. So in terms of the operating profit, it's about 30% of the operating profit. So 2/3 of this business really in terms of the operating profit is the health and the tax and accounting. And then the bulk of the rest comes from financial and corporate compliance, Legal and regulatory is 183 million out of 1.7 billion. And corporate performance and ESG is minimal at the minute. In terms of the valuation, it's performed even more poorly since we last covered it because it's been hit by this AI rebalancing. I mean, it looks like in the last month it's actually now down. It's now up 1.21%, but I think so what happened was at the end of January it was about 80 euros a share. It dropped below 60 and it's now back up at about 68 euros a share. In terms of the valuation, it was a PE of about 14 last time we covered it. It's now at about 12. And the dividend yield's about 3.68%. I like this business. I think on the tax and accounting side, having used the products which do make, which are the biggest earner for the business, I think they're really good compared to some of the other competitors' products I've used at other firms. I wouldn't have much concerns in terms of AI in the near future for that. Obviously, I know you'd mentioned your concerns were up to date, John, and I think for me, that's probably what's putting me off now because that health side is about 30% of the operating profit, so it's not a small figure. I do think it's a high quality business, but yeah, I'm not sure on it still. What about you, John?
Yeah, it's difficult because I've been thinking about it quite a lot since the last time we've covered it. And I suppose one of the things that creates a bit more of a moat against the AI is that you do have that valuable kind of almost IP, if you want to call it that, with the protection around their library that the search is kind of based on. I think the search itself is very vulnerable to sort of AI, but obviously the AI can't necessarily, it's not allowed to trawl through, I guess, that sort of intellectual property almost of Wolters Kluwer. But I do wonder how much of the market is sort of going to settle, even if it's not quite the same quality as what UpToDate is able to deliver with, your ChatGPTs, your Perplexities, and then how much of a demand there still is. And I think there will always be a demand for those peer-reviewed journals. But whether that 60, 70% of that is taken away, that would be my real worry. And I suppose only time will sort of tell on it. But that's the thing that makes me a little bit anxious. Obviously, I have no idea about the accounting side, and I know that you think that's a long, long way away. But yeah, I just don't know on the health. And I suppose for me, at least, I'm not in that kind of research role where I would be using this, a lot. But that's my overall fear. And probably because of that, even though it's got what looks historically like a pretty cheap valuation, I probably wouldn't be sort of going in for it just for that reason.
I thought it was quite interesting as well because at Fundsmith, Terry did get a question on it because Wolters Kluwer is in the Fundsmith portfolio and he was very dismissive of the AI.
Yeah.
I definitely, I wish I was as unconcerned as Terry Smith was.
Yeah, that's right. I think he thought that medical professionals certainly wouldn't be using some of the online tools as much and that they would be going to the source every time. I'm not sure is the answer.
So in that case, of the 6 businesses that we've covered this week, BAE Systems, IHG, Centrica, Coca-Cola Europacific, BHP and Wolters Kluwer, which do you like the most and which do you like the least?
I think it's quite difficult this week because a lot of these businesses are cyclical by nature. There's been a rotation in the market away from sort of what's perceived as not having a moat against AI. And some of these businesses are looking much more expensive and kind of at the top of the cycles. What would I go for? Possibly BAE. But to be honest, I think I'd probably be sitting on the fence. And last choice, harsh, but maybe Wolters Kluwer, just because I'm not convinced in that sort of investment case. Centrica is certainly not a sexy business, but probably Wolters Kluwer would be last.
I think for me, in spite of what I've just said, I think although there's businesses I'd probably rather have in my portfolio, because they're all quite expensive, I think if I had to go and buy one of these 6 today, I probably would go with Wolters Kluwer. I think at a PE of 12, I'd feel like there's more downside protection than if I went out and bought probably what would be my preferred business, which would be either IHG or Coca-Cola Europacific. And they don't keep putting up those growth numbers because those valuations can come down very quick then. But that doesn't mean I'm actually going to be going out and buying Wolters Kluwer. In terms of least favourite, I'd probably go with Centrica. I think in terms of the political climate, it's just uninvestable. So that's quite an easy last.
But I'm just looking at the share price of Wolters Kluwer. So from January 2025 to today, 61% fall in its share price.
Yeah.
It's crazy.
And then I suppose you could take a punt on it on that case, couldn't you? Because is it worth 61% less?
Well,
even if you assume the health business is a total write-off, that's only 30% of the profit.
Okay. Well, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.